Ray Dalio, one of the most famous successful investors of all time, just dropped a bombshell warning that Donald Trump has messed up big time with the tariff bullshit, turning the U.S. economy into a ticking time bomb. Adding to that, Jamie Dimon saying that a recession is the best case scenario. The data is showing the U.S. economy is standing on the edge of a cliff, ready to take a big fat dive. It can only mean one thing. One hell of a crisis appears to be brewing, but what does it mean for your investment portfolio? In today's video, we're going to try to break all that down for you. Spoiler alert, this is your call to action, so you need to pay attention. Ray Dalio, the billionaire investor who basically wrote the damn playbook on macroeconomic cycles. Guess what? He just dropped an absolute truth bomb. He said it's too late. The changes are already coming. This translates into the US economy isn't just in trouble, it's structurally breaking. And Dalio says we can thank Trump's tariffs for lighting the match. Oh, the tinder was there, the kindling was there, the gas was poured on. We just needed the match. It's here. According to him, we're entering a full-blown deglobalization phase in what could be one of the most important economic insights you'll hear this year. Not old Larko saying this stuff. It's Ray Dalio, one of the most famous investors of all time, the biggest hedge fund of all time. He believes Trump's tariffs have put the U.S. on the brink of a total breakdown in its monetary, political, and international world orders. The trade deals that kept the U.S. at the top are crumbling, and it's a mistake of epic proportions. Countries like China and Japan are pivoting away from the US and away from US debt, which means the US will have to print more money to plug the gap, screwing everything up. Inflation will be the cost. Monetary debasement will be the cost. And Dalio is not mincing his words here. The US is no longer the unchallenged king of the hill. Far from it. This is the kind of macro reset that doesn't just shake up the status quo, it smashes everything. It ripples through every investment market, as we can see happening over the last few weeks and months. If the US gets bypassed entirely, and that could be a more and more likely scenario, it means we're headed for some pretty chaotic times. It's not just Ray Dalio waving the red flag here. Macro strategist Lynn Alden is calling it out in her main newsletter. She said a trade breakdown. She points to the same storm clouds brewing. The growing fractures in global trade and supply chains are a key reason that markets are on edge right now, and for good effing reason. This is one of the biggest shakeups we've seen to supply chains and all that stuff in a long time. Trade disruptions are no longer temporary noise. They're systemic and could accelerate recessionary forces. So this isn't just a political mess, it's becoming an economic mess with deep roots and will be very difficult to turn the ship around. Now let's talk about JP Morgan CEO Jamie Dimon's recession prediction. But before we get into that, guys, world's craziest place. You know what's even crazier? Paying more taxes than you have to. That's where we come into today's sponsor, iTrust. Look, if you want a tax-efficient way to be doing the crypto game, you need to check out what iTrust is doing. They're going to let you trade your Bitcoin, your Solana, your Ethereum, your Dogecoin, okay, your Sui, your Cardano, 24/7, 365. They're the biggest retirement provider in the crypto game. So by wrapping all of your crypto trading in a retirement fund, you're going to eliminate all that tax burden, okay? Massive, massive long-term benefits. Look, if you've been trading crypto, you know how much those tax bills suck. iTrust is going to help you out. They're going to help you make sure that you are doing the most tax-efficient trading possible in the cryptocurrency market. Again, all the top coins, deep liquidity, and you can even do in-kind withdrawals, meaning put those coins in your pocket in the future. Plus, you can do real physical gold and silver via the partnership with cked, allowing you to diversify out of the crypto market as well. Get some sweet altcoin gains. Guess what? You can dump it into gold, man. Protect your wealth. Pretty cool stuff. There's a link down below. You can get signed up or just have a conversation. See what the guys at iTrust can do for you. And when you use that link, we get a $100 bonus, which is pretty damn cool. Go check it out. And of course, thank you for supporting our sponsors. Now look, Jamie Dimon, this isn't just some rando Twitter doomer, analyst person, YouTube macro guy, any of that. This is like a serious dude. He runs the biggest bank in America, and a lot of criticisms of Jamie Dimon, and basically everything comes out of his mouth. But Jamie Dimon's out here sounding the alarm during a closed door meeting with the top 500 investors just a few days ago. Not for you, for them, the real people, the real money. That's why this is very interesting. Dimon didn't sugarcoat a damn thing. He flat out said the best case scenario for the US economy right now is a mild recession. Let that sink in. The best case scenario is a recession. He flagged the same issues here as Dalio: trade wars, geopolitical instability, reckless fiscal policy. He's warning that these factors are going to weigh heavily on the economy, and if we don't course correct ASAP, mild recession could turn into something much nastier, aka a depression. And just when you think it can't get any worse, enter Harry Dent. Wait a second, that's not the guy from, oh, it's Harvey Dent. That's the Batman. Harry Dent, not the Batman, not Two-Face. Okay, this guy's been calling for a 50 to 80% market crash, excess debt, too much leverage, endless money printing, all forming what he calls a debt-fueled implosion. So while Dalio's warning us, Dimon is out here flashing the hazard light, Dent's out here screaming fire, while no one seems to be listening. Retail has just aped in the most money ever, basically, on this dip in the market recently. So let's leave the headlines for a second. Let's look at the receipts. The numbers don't lie. The U.S. economy did shrink by 0.3% in Q1. There's already 1 foot in the recessionary territory there. Remember, 2 consecutive quarters of negative economic growth is a technical recession, but they don't count them like that anymore. The DEBIT group, they just decide when there's a recession or not. So technically we had one of these recessions back in 2022. Anyway, over in the manufacturing sector, the regional Fed PMIs are flashing warning signals. New order components are deep in recession territory, which means businesses are cutting back, demand is drying up, and the industrial engine of the United States is getting hammered. Now, it has recovered a bit in the last month, still in contraction zone, but not as bad as it was in March. In April was a bit better, so take that for what you will. Now the services, healthcare, education, tech, finance, they're still hanging on ... for now. The ISM, the Institute for Supply Management, has published its services PMI for April, which came in above expectations at 51.6. This technically means growth is still there in services, and the U.S. is a service economy, so it's worth watching out for that. The U.S. is not a manufacturing economy. The U.S. manufactures a lot of stuff, but it doesn't employ shit tons of people in manufacturing anymore. New orders jumped up to 52.3, but they're holding up, but again, barely. The services employment index is still shaky at 49, which is borderline contraction, but not strong contraction. So we have a tale of 2 economies. The factory floor is flashing recession red. The front desk hasn't gotten the memo yet. Here's why this matters. When manufacturing falls, services tend to follow. This isn't just a vibe shift. It's a chain reaction. Again, the fire was lit. The sparks, an inferno now. Supply chains are crumbling. Factories are looking at cutting back, all this kind of stuff. And if you zoom out and you put Dalio's deglobalization thesis into play here, Dimon's recession warning and Dent's crash call to the data, well, we're looking at a potential macro meltdown. Great, Lark. So what the hell do I do? Well, you stay macro aware. Traditional assets are under pressure. The US dollar is losing its shine. Now, Trump wanted a weaker dollar and he's getting it. Interest rates are cornering policymakers. Oil's trading like a recession's already here. That all makes Bitcoin and crypto more relevant than ever, though. Not because they're immune to macro events, but because they're outside the legacy system. No one tariffed Bitcoin, did they? If the dollar falters, capital always looks for alternatives. Gold, yes. Bitcoin, maybe. Look at the recent relative strength when the stock markets were melting down. Bitcoin was actually doing okay. But this is not the time to YOLO into hype coins or pray for another meme coin mania. That risk environment may not be here quite yet, but it could come at any time. One news story could change all that very quickly, so keep in mind, okay? But this is the time to double down on the strategy. Diversify, stay liquid, hold assets with real utility, ignore the noise, stay away from the big picture. This is actually the time to double down on simplicity, on your basic strategy. Diversify, stay liquid, hold assets with real utility, ignore the noise, stay aware of the big picture, the macro, because that's what's going to really decide how markets play out for the rest of 2025, and we need a reversal here at some point. Dalio's warning isn't about fear, it's about timing. The game is changing. The old rules are dying, and if you'd wait until it's obvious, it'll be too late. The winners in markets are the ones who prepare before the panic. In times like these, it's the ones who stay ahead, stay educated, and keep a cool head, who come out on top later. There's always opportunities out there. Don't let the doomer shit get you down. It's important to stay aware of everything I just mentioned in this video. Oh, that's very important stuff, and you'd be unwise to ignore it. Bearish sentiment is at extreme highs right now. Can we have a party on the deck of the Titanic before the ship sinks? Of course. Can we still avoid the iceberg? Obviously. But that window's closing, and you need that window not to close. 2025 still has a lot of great potential, but we need to see some resolution of some of the worst stuff here, or as these guys are warning, shit is gonna hit the fan. Thanks for watching.